there are some real conscious decisions that mining companies can make now to really decarbonize what they're doing.
When you look at the junior miners leading the way with projects that they're looking to develop with zero emissions, it's not 2050, it's now. That's really been driven by the finance available to them.
Our impact is measured in terms of the impact that we can have by partnering with the companies that we invest in to try and work with them to get them onto trajectories towards net zero.
I think it's really important that the proponents of projects are able to go to the world and say, the reason this project needs to happen is bang, 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 and have very strong evidence and social support for that.
Welcome viewers to this webinar on decarbonisation, brought to you by Assay Live. As everyone filters in from their various locations around the world, filters into the webinar, I'll just run over the format and a couple of the themes that we'll be addressing, and then introduce our panel and we'll get going. I have a selection of questions submitted by webinar registrants in advance. Thank you for those. We'll cover them directly and indirectly in the first half of the webinar, but should anyone like to submit further questions, there is a Q&A tab that you can type into, so please go ahead and submit those and we might be able to come to those towards the end. So we're going to be focusing on the path to zero carbon in mining and hearing from a group of highly experienced stakeholders, from shareholders to mine operators. And today is also a timely discussion with COP26 in Glasgow next month, a metals bull market in the backdrop and tightening supply chains across many different sectors around the world. So introducing my panel of experts to tackle the topic, I have with me Nick Stansbury, Head of Climate Solutions and Investments at Legal & General Investment Management in London, Ian Maxwell, Operating Partner at Pacific Road Capital, currently in Belgium, Mark Selby, Chairman, CEO and Director of TSXV listed Canada Nickel in Toronto, and James Whiteside, Global Head of Multi-Commodity Research, Metals and Mining at Woodmac in London as well. Warm welcome, gentlemen. Thanks for joining me. Nick, could I turn to you first then? As a leading investment firm taking decisive action on climate change, how is LGIM supporting efforts to reduce carbon emissions and reach these net zero targets set for 2050?
So it goes without much surprise to point out that for us, the big issue is not our own emissions from plane travel or from keeping the lights on this building. That represents a very tiny fraction of our effective carbon footprint. Most of it comes from the companies to whom we provide our clients' capital. So our impact is measured in terms of the impact that we can have by partnering with the companies that we invest in to try and work with them to get them onto trajectories towards net zero. That's done through effective engagement, the selection of the right companies to be providing that capital to. And when we think about that, we think about putting companies' emissions into broadly three boxes. We think actually companies would prefer to put it into at least five, but there are at least two boxes there that we don't think should exist. So there's a box which is labelled reduce it today. There's a box which is labelled eliminate it tomorrow. And there's a box which is labelled make a plan to eliminate it soon. There's no box for us that's labelled too difficult, too complicated, and nor is there a box which is labelled somebody else's problem, which is how many mining companies unfortunately seem to regard their Scope 3 emissions. We don't think either of those boxes exist. So it's really about working with our companies to understand how few of their emissions have to sit in the box labelled make a plan to deal with it soon, and to try and get as many of them into those boxes which are labelled deal with it today or deal with it tomorrow. Does that make sense, Adam?
Yep, absolutely. That's excellent. And so your specific role, you're helping these companies do that, but also looking at new investments for companies and where they fit within those criteria. You've been quite decisive with this action plan, though. If I'm right, there's been some divestments, and can you just talk us about, how you're actioning these criteria that you've explained?
Yeah, so we have a sort of separation of powers when it comes to this a little bit, and And my team's role is not on the making the decisions about which companies need to go, and much more around helping to measure and quantify the problem and the impact. So our team my team and I exist really to try and put answers to 4 thorny questions. So what does climate change and energy transition mean for the global economy? What does it mean for any individual company in terms of the risk that it poses to the company? What does any individual company mean in terms of the probability of the world achieving a certain climate outcome? So not talking about risk, but trying to quantify the impact the companies are having on the climate outcomes, and then trying to project and understand how investors' carbon footprints and therefore how companies' carbon footprints are likely to change over time. And for us, we can think about that as a sort of 2x2 matrix with companies that are highly resilient to climate change risk or transition risk and are well aligned to good climate outcomes, sitting there in a box up in the top right-hand corner. And then some companies that unfortunately are sitting down in that bottom left-hand box, which is saying companies that look deeply vulnerable to transitional risks and are also not changing at all and not doing anything about those risks and are helping to contribute to a very unacceptable climate outcome. And it tends to be those companies that are the ones where our attention is most focused. But the ultimate decisions are taken by a decision-making body that's very separate from the people that are responsible for measuring it, as I think it probably should be in a company like ours.
Yeah, absolutely. Well, I've got to pry into that then. How have the mining companies fared within, or the ones that you certainly deal with or look at? I know you tend more towards the majors and the larger mid caps. But how have they fared within that matrix, and what's the sort of attitudes that you're seeing from the executives that you're speaking with?
Yes, so we see that the mining industry, it's a really unique industry for us in the way we think about you, because you're both simultaneously some of them likely to be some of the most negatively affected by carbon externalities becoming properly priced. Clearly, really energy intensive industries, really vulnerable to energy transition risks if poorly managed, and with really, really high carbon footprints relative to other parts of our portfolio. So somewhere where attention is really focused in terms of kind of carbon impact, but also absolutely critical to delivering many of the new minerals that the world needs to get ourselves onto a sustainable pathway to a net zero outcome. So really interesting sort of juxtaposition of those two factors both at the same time. So for us, mining really, really important to focus in on because we think the world is going to need vast quantities of a small group of really critical metals and minerals. It's going to need wildly smaller quantities of some other things like thermal coal. And therefore, the way the industry engages with that is really important. Unfortunately, mining industry response to Scope 3 not always been perfect. Which is why I talked about sort of the 4th and the 5th boxes that mining companies sometimes want to put emissions into. The one that's labelled not my problem is the most troublesome one for us. And I think where we are spending a lot of time is on trying to engage with the industry to make sure they understand that there are no emissions that fall into that box. Your Scope 3 emissions are not somebody else's problem, they're your problem, and that they need to be addressed, even if addressing them means putting them into the 3rd box, which is something we need to make a plan for and communicate a plan about, even if we aren't able to actually take action to drive them down today.
Yep, definitely. Just to clarify, Scope 3 is the indirect emissions that we're talking about. So the whole value chain of the operate, not just what the miners are producing from the ground.
Yeah, exactly. We're talking about that really thorny question of what happens to that ton of iron ore after you've sold it. And what are the emissions that are associated with it as it goes into a blast furnace? Is that your problem as a mining company? Well, unfortunately, some mining companies seem to appear to believe it's not their problem. It's someone else's problem. It's just not true in our view. In our view, that's your problem, and you need to take ownership for it and understand that you need to be making plans for how to get that number not down a little bit, but down to zero over time, and what that plan looks like.
Yeah, excellent. Great stuff. Thank you. James, could I turn to you? Woodmac is a firm, obviously, right at the confluence of investment banks, government, and corporates as well, and of course, oil and mining majors. With your technical, operational, and financial pillars that you address, how do you see the complexity of this challenge of decarbonising our businesses?
Well, yeah, it's a huge challenge, and the biggest change that the metals and mining industry has faced in most of my colleagues' work span. This audience is well aware that metals do serve a wide range of end uses integral to the energy transition. So you've got huge double-digit demand growth expected over the next few decades. And at the same time, you've got supply chains which are under pressure due to their high emissions. Steel, for example, is between 7 to 10% of emissions globally, depending on how you measure it. So what my team do, pertinent to today's discussion, is around emissions benchmarking and climate scenario analysis, which commodities will be the winners and the losers in the energy transition. So companies can use our analysis to identify opportunities to reduce emissions, to hit those net zero targets, and also market themselves on their carbon credentials. Investors can use the tools that we develop to assess the impact of carbon policy that's rapidly emerging, and is a real risk to the valuation of metals and mining companies on their portfolios, but also look at, okay, how much capex is actually required for those companies to hit those targets, which I think is an unallocated factor in many mining companies, many of the diversified mining companies' financial outlooks.
Yep.
So yeah, that's really what we do.
Yeah, and broadly, do you think that the companies are embracing the change and meeting and addressing some of the key hurdles that Nick's outlined that are essential for reaching these decarbonisation goals?
So look, there's some really different approaches. When we look at the majors, the diversified miners, they're talking about net zero 2050, 30% over the next 10 years. And really the action that they're taking is the measures to abate carbon that make sense from an economic perspective today. It's sort of move to renewables without even storage. So I think that's having an impact. It's not really a rapid move to decarbonize. It's really 2050 is their horizon. And those buckets which Nick outlined, a lot of stuff sits in a bucket which sits in the 2030s. So I do think the diversified miners could become the laggards here. And when you look at the junior miners leading the way with projects that they're looking to develop with zero emissions, it's not 2050, it's now. And that's really being driven by the finance available to them. Investors are really lining up to support them. And then you've got governments and export credit agencies on the debt side as well. So I do feel like there's going to be a situation in the late 2020s where you're going to see low carbon, zero carbon mines in operation, and they're going to sit outside the portfolios of the diversified miners. So that's going to create an interesting dynamic. And then of course you've got the third group, which is basically privately owned, not Western companies, where emissions is only going to become a factor once they're selling into these renewable markets, which require them to decarbonize. So very different approaches being taken depending on what the company is.
Yeah, indeed. It's an interesting final point there, and around dropping investment, but making it available for someone who doesn't have the same sort of ESG requirements or is happy to finance something that because their regulation isn't as strict. Perhaps we'll come on to that later. Ian, could I bring you in here? You're chair of Pact Road's ESG committee, so you must have a vast and expanding oversight of what makes a responsible investment. Do you feel the right kind of change is coming in the mining sector? Is stakeholder engagement improving across the various tiers? And how's it different from a private equity perspective than perhaps from where Nick's sitting?
Yeah, look, there's a lot in that, and there's a lot I'd like to pick up on some of the previous comments from Nick and James and others as well. So I really dual hat two things. I work with Pacific Road as an operating partner, a private equity investment firm, but I'm also the chief executive of a metallurgical coal development company in Canada. And there's really a few elements here. I think from a broader ESG perspective, there's no doubt in my mind that the diversified companies have really led the way in putting through ESG standards that are of best practice. Now, you can look at smaller companies around the world and you can say, yeah, there's a difference. But I think if you look around and sure, the big mining companies have had challenges around corruption and other things, as we've seen recently, tailings. But if you look across the board around most of the ESG issues, I think they're doing a good job. What we see in the mid-tier investments is that at Pacific Road, we've had to put our own ESG operating model in place where we can actually go and sit with our investee companies and say, look, these are the ESG things that are important to our investors, who are mostly North American LPs. These are the things that are important to us. And we don't want to write the policies and standards, but we want to point you to the right organizations you should be looking at in order to deliver best performance. So with that, it could be FCPA, Foreign Corrupt Practices Act, it could be the global tailings standards, that's been put in place, etc. Around carbon, I mean, I kind of have a similar view to James actually, which is I think carbon might be a little bit different. And what I'm seeing in the carbon space is that it's actually quite difficult to reconfigure existing operations. But if you're starting with a new development, it's actually quite easy to hit, not easy, but it's relatively easy to hit carbon targets in a much shorter time frame, net zero in a much shorter time frame. So for example, at North Coal, we're building we're permitting a metallurgical coal mine now. It's our objective when that comes on stream, it's net zero. And that will be probably before, that'll be between 2025, 2030. So we are working actively now with the University of British Columbia, with equipment suppliers, etc., to make sure the decisions we take will lead to us being in that position by 2030. And to go to Nick's point, I mean, I think, I wouldn't say scope 3 is entirely the mining industry's problem. In our case, where it would be hard for us to solve that by ourselves, but it's sure as hell a place where we can go and partner with steel mills and universities and research groups and others and start having a plan around, okay, how do we collectively deal with this, because we need to. So look, that's our that's the approach there. I think the other thing from a Pacific Road perspective, clearly, there's two things we've got that we have really in our portfolio. We've got the positioning for energy transition and investing in the commodities that are going to be, as Nick and others spoke about, high growth and powerful for the transition. That's great. But we also have things like, met coal and other things in our portfolio, which seemingly at first sight might seem as if they're not matched to the transition. But actually, when you dig into it in a little bit more detail, as we might be able to do later on this call, you find out that some of these things are actually part of the solution as much as the others. And there are sure things you can do within your own portfolio to reduce emissions to zero, but also, not all coal is bad, as you'll find out as you start talking through the metallurgical coal stories.
Yeah, well, yeah, it's an interesting point, and we definitely want to come to it with a few topical things on that. I will just revisit that in a minute, but I would like to get your thoughts on that and from your position with your company in BC as well. Mark, I'd just like to bring you in quickly to complete our introductory round, and just wanted to touch on your point of view as an operator and someone who's doing quite a lot in the space early on. There's a perception that juniors are more cash constrained, haven't necessarily got the capabilities to implement low carbon practices from the off, but actually it seems like you're doing quite a lot to disprove that. Can you just maybe introduce Canada Nickel and some of the actions you're doing on the decarbonisation side?
Sure. So yeah, We were rapidly advancing a large-scale nickel project just outside Timmins, Ontario, in Canada. Feasibility study coming by this time next year. I think in terms of zero carbon now, there's that is what you sort of have to come in with mindset. And I think it first starts off with in terms of A, it's the right thing to do, but B, when you have these fundamental macro shifts, those are the opportunities for those, truly sort of generational type of returns on investment, when you're a leader in front of one of these macro shifts. And I think from a portfolio perspective, first off, mining companies, there's less than a dozen jurisdictions globally that have a low carbon electrical grid. So if you can look for mining assets that are close to those low carbon electrical grids, you inherently have a big leg up. In terms of the metals themselves, again, some metals, generally all of the carbon footprints are generally relatively consistent, and in other metals there's massive gaps, which again, if you are able to be low carbon, you've got a huge amount of potential. And nickel obviously is one of those metals, relative to the other parts of the periodic table. For one part, the bulk of growth in supply has come from very high carbon sources in Indonesia, literally 80 to 90 tons of CO2 per ton of nickel. And we have the opportunity and believe that we can deliver a zero carbon nickel cobalt product to the market, by the middle part of this decade. And the nickel, obviously, as the key component in high energy density batteries, is going to play a critical role and is going to see tremendous demand growth in that time frame. So, choosing the right asset, choosing the right location from a portfolio perspective, I think is critical to do it. Then the second stage, and again, this is where as a developing asset company, you can make the design choices up front, which is easier than if you have a legacy asset that the larger companies are saddled with. So, we've from day one looked at where can we use electrical mining equipment to be able to minimize the amount of diesel consumption that's there. And so, quite happy that, with our PEA that we just released, we're down in the lowest decile of the carbon footprint. And then one of the other big advantages of the specific type of nickel deposit we have is the tailings and waste rock, which make up the minerals that make up 85% of what we're mining. They have the property that when exposed to air, they spontaneously absorb CO2. So we're doing the work right now to be able to quantify exactly how much carbon, our rocks are going to be able to sequester. And there's companies that are looking at injecting CO2 into these types of formations around the world. So the fact that we're grinding it up and creating lots of surface area, is a huge advantage for that. So, I think that, there are some real conscious decisions that mining companies can make now to really decarbonize what they're doing. And again, I think the diversified, looking at analogy from, something that historically was deemed to be a real health hazard was, smoking, 20 years ago in terms of cigarettes. And to me, I think the big diversifieds who still make huge amounts of money from iron ore and met coal are the tobacco farmers. In that analogy, it's like, oh, we make this product. We make lots of cash making this product, but whatever happens with it after we make the tobacco is somebody else's problem. And so, the big mining companies, again, you need to, speaking locally here, own your shit and figure out a way to get it to market, with reduce the carbon. We're going to be looking at co-locating our downstream processing as part of our operation to be able to get to that, end to end as low a carbon footprint as possible. And again, I think the big companies can make portfolio decisions, and they're going to need to start making portfolio decisions if they really want to be serious about reducing their carbon footprint.
Yeah, absolutely. Excellent. Just thinking about your point around downstream, you're in the sort of pressure that might be on Canadian projects to produce for the electrification of North America. You're in Ontario, close to Detroit, an automotive hub. Presumably the value chains being closer and localized is an advantage. Is that part of the strategy further down the line?
Yeah, for sure. No, we are in the fortunate position that we are, one of the nickel deposits that's, closest to most of the U.S. auto production facilities. So somewhere between our mine, and these auto plants will be a great place to convert nickel into use for batteries. But then another big portion of our nickel, we're planning to convert into stainless steel. And again, we're looking at ways, one, we have low carbon hydroelectricity available in the region. So, that it helps us make a lower carbon stainless steel. And then as well, we're a large forestry products region around the Timmins area. And there's a lot of waste wood product that we're going to be looking and start working with companies to figure out how to use biochar as a carbon source, as opposed to using coal or some other, some other carbon generative type product to be able to have the reductant that you need to make stainless steel, again, with the lowest possible carbon footprint.
Yep, absolutely. So keeping on that theme of sort of changing supply chains, changing the where we sort of get raw materials from, where we refine them, moving them on, and sort of linking back to where we paused on coal, actually. Ian, I just wanted to bring you back in, and we can address some of those issues there. It seems the developed world, Western markets, are in a scramble to increase, reduce dependency on China for a lot of materials, but at the same time have issue with putting projects on their shores. A lot of green activism, and perhaps for completely the right reasons. But there's a big conflict of what's going on here in terms of ramping and scaling up industry versus what you want in your backyard. How has this impacted what you're doing with North Coal in BC, and the sort of misconceptions around met coal versus thermal coal, for instance?
Yeah, look, it's a good question, and it's a good area to explore. The reality of the steel industry, it is 8% of global emissions, and currently about just over 2/3 of it, 70% of it comes from blast furnaces and 30% comes from electric arc furnaces. Right. So you'll have seen announcements in places like Canada recently, and also in Europe, real works to try and decarbonize the steel industry by moving to electric arc furnace, using high quality recycled scrap, using renewable energy, etc. That's possible in certain parts of the world. It's hard to do though en masse, because one, the world needs a lot of new steel. Secondly, recycling rates in steel are really very high already, 80–90%. And thirdly, there are only certain parts of the world that have access to high quality scrap, DRI, or other things that could go into EAF plus renewable energy. So you've got 70% being produced by blast furnaces. And one of the challenges the world's got is when you look at that capital stock, 75% of the world's blast furnaces are younger than 13 or 14 years. And they have a useful life of 40+ years. So the IEA, the International Energy Authority, has done some really very progressive work looking at this area. And one of the realities they see is that the blast furnaces are going to be around for a long time. And in part, that's because of the young capital stock. In part, it's because 85% of those blast furnaces sit in emerging nations. In part, it's because the steel industries, in the good years, maybe they get as far as a 10% return, but normally single digit. In bad years, it's negative, and the cash available for transitions is not particularly high. But I think what is also astounding is what the IEA have looked at is the degree to which the steel industry can decarbonize, even using blast furnaces. And currently, in the energy mix in steel, about 70% comes from coal. If you look at the IEA Sustainable Development Case, which is what would the steel industry would need to do to meet the Paris Accord, so it's not the base case, but what would need to be done to meet Paris. Coal goes down from about 70% of the mix now to about 50% by 2050. So still 50% of the energy mix by 2050, but the steel industry itself can decarbonize by taking out almost 50% of its emissions. And the reason is simply there's a lot you can do in blast furnaces to improve emissions. Okay, the difference between the best performing blast furnaces and the worst is enormous. The technology differences are enormous. There's much you can do just by bringing everything up to best practice, even before you start looking at sequestration or new technologies. So that's the world we face. But I think the realities around coal are, in order to reduce emissions, you've got to reduce coal usage in a steel furnace. And if you think about the properties of metallurgical coal, it's partly as a reductant in the mix, but it's partly to support this charge of materials that you put in, the iron ore and the other things. So less coal, it turns out, means you need to use higher quality coals that produce higher quality coke in the furnace has a higher coke strength. So we can cut down coal usage, but we actually need to use coals that produce a higher quality coke. And the challenge with that is, one, they're relatively limited. Secondly, the resources that of that type of coal will be exhausted over a coming period of years. And thirdly, it's incredibly hard to permit, finance, etc., new coal operations. So the one product the steel industry needs to help in the transition to net zero, which is a high coke strength, a high CSR coking coal, actually looks like it's going to be an incredibly tight market going forward, and it's going to be difficult for the industry to get that, which means the steel industry is going to end up relying on lower quality cokes, and that's not a great outcome for anybody. So that's the steel industry demand picture we're looking at. And so our approach is really, our product to North Coal is a high coke strength, a high CSR coking coal. And our approach, therefore, and picking up on exactly what Mark was talking about, we're in Canada. We have a low carbon electrical grid with scope 2 zero. We can do an awful lot around our operations by reconfiguring from trucks to electric conveyor belts and other things. And we also own a forest products company in a substantial land position, and have partnered with UBC and a number of others to think about what we can do around carbon storage in tailings facilities, as Mark talked about, biochar, which is an enormous opportunity for us in that part of the world. So we think we can actually produce certainly from site a net zero scope 1, scope 2 emissions product, which will be what partly part of the steel industry transition to net zero. Our challenge, and Nick highlighted this earlier, is how do we get to net zero on scope 3? And for that, we need to really partner with steel mills, and that's going to be joint projects. And that's exactly what we're turning our attention to now. And I agree with Nick. You can't just bury your head in the sands. You need a plan around that, and that's what we're working on.
Yep, excellent. Just wanted to pick out what you were talking about with the difficulty of financing, and just highlight, is the future of met coal projects or projects that are slightly typically harder to finance because of the decarbonisation trends. The capital is going to have to come from private sources like private equity, for instance, or specialists that really have got to grips with the technology and have the capital. And within that, thinking about the LPs that put into the funds, is the mindset really changing there significantly where they're moving away from coal?
Yeah, look, it's no different. I mean, our investor base as private equity is no different in many ways from the investor base that is in other forms of capital provision. Our investors are big LPs, university trusts, etc., that put their investments in partly into private, partly into other managed investments, etc. So we're subject to the same requirements that Nick and Legal & General and others will be subject to. And so one of the challenges, I think, for the steel industry is as they look to transition over a very long tail of blast furnaces to net zero, and they need certain types of product to feed into that, we are going to see potentially a very substantial supply-demand deficit of exactly the sort of products they need to help them in their transition. And it's very easy for the Western world to bury its head in the sand and say, well, it's a problem, it's not a problem we need to deal with. But given 85% of these things sit offshore, but the reality is 40 to 45% of US steel, not apparent steel, but total steel used in the country, and that's it's semis, it's right the way through to finished goods, is imported. I mean, 40 to 45% of US steel consumption has been offshore. And so whilst we have that situation, I think it's absolutely critical on the Western world to think about steel as a global problem and not just what we can do within Canada or Europe or somewhere else.
Yeah, certainly. So something like the new Cumbria coal development that's sort of being held up at the moment for environmental issues and action is quite paradoxical, really, because you want to shorten the supply chains, do the development right with better technology from the start, from the developmental stage, and that will actually help in the long run.
Yeah, look, I think one of the things the industry has done poorly, and it's something we're turning our attention to now, is spend time with governments, regulators, NGOs, communities, whoever it might be, to really put out there the good, the bad, and the ugly, because it's very hard for people that are not technically or spend all their time, worrying about these problems as we might, to really work out what the difference is between a thermal coal mine and a high CSR metallurgical coal mine or whatever. So, I think it's really important that the proponents of projects are able to go to the world and say, the reason this project needs to happen is bang, 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 and have very strong evidence and social support for that. And I think our industry's been poor at that, and partly because the proponents of these particular projects historically have also had a broad portfolio of other coal and other things, and it's just not been in their best interest to do that. And partly also because I just don't think that, I think the industry has been slow in responding to where societal concerns are. But for me, if we can't absolutely go out and explain why the world needs North Coal and this particular product, and we can't absolutely go to the world and say we will be net zero carbon by the time we start production or shortly after that. And for the bits where we're unsure, these are the credible partners we've put in place. This is our plan. This is how we're going to go about it. Might not have all the answers now, but look at who we're partnering with, and hopefully that'll give you confidence. I don't think these projects will get up. And so I think a lot of the challenges projects are having is ultimately comes back to the proponents and the approaches the proponents have taken or not taken. And it is hard in met coal, make no bones. I mean, it is much harder in coal perhaps than some other areas because of the scrutiny. But also there are some opportunities there, and we've found in our conversations with government, if you can get to the right people and talk the right messaging and explain why your offering is different, the world is open to listen.
Yep, absolutely. Fascinating. Great. Could I just flip back to scope 3 and Nick, some of the things that you were saying, maybe go into a bit more detail there about actions across the value chain. Do you think this is an area where, well, you highlighted it was a bit of a challenge, but do you think that this is an area that's improving, that executives are quite cognizant of, but it just seems to be the main hurdle at the moment?
Yeah, it's a good question. So I think there is increasing awareness of the magnitude of the importance of tackling the problem, but I don't see great evidence yet of real tangible steps beyond nice sounding PR statements and press releases. So lots of great press releases, lots of little projects here or there. Little sort of substantive evidence. I think what we're really looking for investors is not we don't have unrealistic expectations. I think that you can wave a magic wand and make the problem go away by waving something and it should magic it away. Right? It's not going to happen. Dealing with those big downstream emissions sit in that box of make a plan. But I think the first thing that we would really like to see is really detailed, costed plans for what dealing with it is going to look like, and how you are going to move from where you are today to where you need to get to. That's going to involve working with customers, but I think there are plenty of other places in the mining industry where we've got analogies of the industry taking hold of problems that were not technically, strictly theirs to deal with. Fatalities, I think, it's by no means a perfect analogy, but it's pretty close. A really good example of how the industry actually showed the way on how to deal with an issue like this. So I think cost it up, show us what those numbers look like. I don't think the answer is going to be in the numbers, but I think there's going to be great reassurance in showing us the working. So it's not about putting the right answer on the exam paper. It's about showing you're working to us, which will help us to build confidence that the industry is tackling this and tackling this on a company by company and case by case basis.
Yep, excellent. James, did you have anything that you might want to add in around the scope 1, 2, 3 and deliverables there?
I think the scope 3, like any industry, is always going to be larger than scope 1 and scope 2. It's pretty much the same any industry you look at. The problem is greater in your customers' emissions because of what scope 3 is. The emissions downstream is huge. The emissions upstream can be huge as well. Scope 3 is a big problem. But I think what I'd like to say is around how companies tackle scope 3 and really start to address that. Similar to what Ian was saying, is it's really about partnerships. That's really the only way that you can accelerate the decarbonisation of your customers. And the threat there, why companies really need to do that, is because that end market may not exist, right? So that's the way companies need to think about it. It's not a scope 3, it's someone else's problem. That's your end market. If that disappears because carbon emissions are too high, gets taxed out of the market. When you look at aluminium, for example, it's not going to be fully substituted, but if emissions stay higher than they are today, aluminium smelters will be subject to huge carbon taxes. If they're selling into Europe, that's definitely going to happen. If they're selling into the US, probably, and the rest of the world may well follow suit. So if you're a bauxite or an alumina producer thinking about scope 3, there are some real existential issues there that need to be tackled.
Absolutely. It's a good point.
Sorry, can I just add something to what James has said, because it's important. We also look at where we sit on the cost curve based on carbon pricing, not based on where we sit on the cost curve today. And so there's a real opportunity for us to move down the cost curve relative to others if we get this right. So we see it as a source of competitive advantage. We've also partnered with a blockchain organization called Circular, who some of you may know, and that is all about, if we move down the cost curve in a net zero, how do we capture the value and use of that product? So it's not just a cost issue, it's a competitiveness issue. We think we can become more competitive, and we think we can extract value if we can actually track that value through the steel mills and ultimately through to the OEMs. So I think that's the possibility, and that's the carrot that we're angling for, and it's as much a carrot as it is a threat, because we see we can be preferentially better placed in the industry than we are just based on the resource we have, given the things that Mark was talking about that are natural advantages in Canada.
Yeah, absolutely. It's an interesting point around blockchain. We had a question submitted around blockchain as a technology, and I don't know if you can disclose a little bit more about what you're planning or how you view it, but blockchain in a computer capacity sense has its own environmental footprint, but it certainly has a great capability to help with provenance down the supply chain and things like that. Do you see it as a part of the solution that most companies are going to have to embrace?
Look, I think it probably is. We're very strong at Pacific Road on traceability and transparency and everything, as Nick would be at Legal in General. Transparency is the starting point really for every conversation. And in terms of the OEMs that we will ultimately, the steel ultimately goes to, be it progressive companies like Volvo and Polestar, etc., they're going to want to know the provenance of what they're getting. So, blockchain to us really is a way of working through capturing the ESG credentials beyond just carbon, but a full suite of ESG credentials for our product through the supply chain, through the steel mills, ultimately to the OEMs. Yep. What we think that'll give us, it'll give us a broader market. It'll give us a market where customers are more likely to pay for that additional value and use if we can demonstrate it. The challenge in this is the midstream. I mean, the challenge is engaging the steel mills and the steel industries to be part of that. But yeah, I mean, we see it as an integral part of the product offering down the track, and something that be that investors or government or regulators or anyone else are just going to want to see that you're doing those things that are necessary.
Yeah, absolutely. I want to quickly pick on the idea of premiums for products, given the high price environment that we're in, but then also the scramble for battery grade metals, for instance, battery grade chemicals. The scarcity is going to, and if you combine that with the sustainability and the traceability elements, is that going to drive new premiums on the market? Mark, I don't know if you're planning on adding a premium to when you start producing and selling to the EV manufacturers.
Yeah, no, I as much as I would like to say, yeah, next week, we'll see some premiums emerge, but I think the mechanism where you're going to start to see some real premiums emerge for low zero carbon products versus higher carbon products will be when the European Union implements their, import carbon tax on various products. I think until you sort of get a clear demonstrated financial amount that's in the market, that will be the big trigger, for that to happen. And again, it'd be nice to get 100% of whatever that tax difference is, but it'll end up being some proportion of that. So, I do think, for particularly, again, for metals where you have substantial amounts of the supply curve that have very high carbon footprints relative to what you're doing, and that will be the key determinant of your ability to capture that premium. That's going to be the trigger for it, I think, is sort of the middle part of this decade when those things come into force in the EU.
Yep. Okay, so I'm just going to rattle through a couple of other questions that we've had in from audience prior and also during. It might be a bit sporadic, but let's go through what people want to hear about. Firstly, there's a lot of questions around, is the pressure now on Canada and Australia to supply the world's minerals, because they seem to be the only jurisdictions that can tick all the boxes for sustainability, for hydro, for solar, for instance. Is the industry moving that way in terms of where investors are going to be able to stick their capital? Does anyone want to tackle that? Yeah.
I mean, again, I think those countries, as I described at the beginning of my, introduction, I think there's some places that are inherently easier to do it. And yes, Canada and parts of Australia are in good place to do it. But, there are some other jurisdictions globally. And then I think you've seen recently in the last 6 months or so, some of the majors really announced some substantial renewable projects, in parts of the world like Western Australia that has a high thermal, part of their grid, and then places like Chile where you have remote locations that are typically diesel only, but they are actually really looking hard and building sizable quantities of solar and wind power. So, I think, cautiously optimistic that, again, in the right location where you have the wind capacity and solar capacity to tap into, that the mining companies will make investments in those locations to be able to do it. But again, it's asset specific, where those opportunities are, that are out there.
Yeah,
Adam, I think the bottom line is resources are where they are. My very first geology boss, when I first started Rio Tinto years ago, used to have a phrase, where it is, there it is. And to a certain extent, that's true. What Mark was talking about, and I think James to a certain degree as well, that the availability of, for example, hydro and green energy close by, that has the ability to change the supply curve a little bit in terms of cost of production. So that clearly has a difference. Will everything come back to Australia and Canada? No is the answer, because, I mean, you see, for example, Fortescue Future Industries looking at investing pretty heavily in Inga and the Inga dam projects in Congo. Clearly, if you've got massive green energy coming out of Inga, both for green hydrogen production, but also for the production of downstream processed products in that part of the world, that could become a very important supply center down the track, not only for hydrogen, but also for other things. So, look, I think it comes back to, can we as companies that want to manage our investments in a world-class way across all the things that society would expect fit with the sustainable development goals, can we manage those in those jurisdictions? And the answer to that in certain parts of the world has been mixed, and we need to demonstrate that.
Yeah, certainly. Okay. There's a couple of questions come in around the intermittency of renewables, and one just popped up for you here, Mark, as well. The intermittency of renewables not being fully reliable, or for instance, if you think about what's going on with Ethiopia, I believe it is, with the massive hydro project they're building there, but it's also causing huge issues for the Nile further downstream in other countries. Hydro itself isn't entirely environmentally friendly, depending on where you're sticking the dam. there's got to be a fallback option, or what that's what I'm getting at. How do you, as businesses and investors, sort of factor in the risks around renewables or not being a perfect solution, for instance?
Yeah, so I mean, to me, I think it sort of falls on two things. One, again, we're fortunate we're in an area with multiple hydroelectric dams. So, for our specific case, that's not an issue at all. But, I think in areas, where that is an issue, fortunately, battery storage is becoming, a much more viable and reliable option, to be able to build in as part of the renewable solution, and then again, the nice thing, that we're looking at, and again, the having the opportunity to start from day one with a project and thinking about ways that it can contribute to, the broader lower carbon across the province is, we're in an area that's quite flat, and we'll be creating some terrain between digging a big open pit and having waste rock dumps and tailings facilities that'll be at some height. So, one thing we're looking as an option is to actually build in some pump storage capacity where we can use that elevation difference once we're finished mining certain pits, where we can use that, to help. In this case, we don't need to balance the power that's available, but the price of power in our jurisdiction swings wildly based on the time of year and certain times of day. So if we can create a pump storage facility that helps the entire grid do a better job of utilizing the power that's available, then that's a way that you can create a net benefit.
Yeah.
Do you want me to have a go at that as well?
Please, Nick. Yeah.
Yeah. So look, when we think about this issue around intermittency and balancing, we try and break it up in our minds into four intermittency horizons, which we think about. We think about spot, which is to say frequency balancing, maintaining grid frequency, ultra short-term balancing. And the issues around that definitely increase as you add renewables to a grid, but they're definitely manageable. From everything we have been able to see and understand from the companies that we talk to in these areas, it's a relatively manageable issue, which you can sort of set aside as kind of a separate sort of technical issue. You've then got short-term, sort of intra-seasonal type of balancing horizons, where you're saying from any given week to week or any given day to day, you have the need to add quantities of balancing capacity, given any specific level of renewable penetration on the grid. That's the horizon around which I think batteries, as the prices fall, will have a really meaningful role to play. Then you have another horizon, which is the really, really challenging one. And that's the horizon which gets bigger and bigger the further you get from the equator, which is more between seasons. So that is to say, between summer and winter, where your generation profiles and your demand profiles look wildly out of kilter with each other. It's a classic example of this is North Europe, when we think about the electrification of heating. Here in the UK, we have a massive issue with the fact that you have this wildly different generation and demand profile, and the gap between the two really widens out as you look at that between seasons. That isn't an issue which you solve, I don't think, with batteries, simply because the quantum of what is involved is so absolutely enormous. And so here we're looking at things like nuclear, which probably has a really important role to play in some markets in trying to balance that. And then the fourth one we think about as a sort of overcapacitization requirement type horizon, which is a little bit like the situation that we see at the moment here in Northern Europe again, where you just, the wind's not blowing. And we have the wind not blowing when we add it to all sorts of other problems that get compounded up onto a grid. And that's a situation, again, which I don't think you solve with batteries. You solve a little bit with overcapacity, adding extra capacity. There's modeling you can do around that. But that is an issue, again, where I think you need a plurality of supply sources. And that's where you look at things like gas as backup. And that's where you're going to have to combine it with nature-based solutions or with CCS or other things in a net zero type system. I don't know whether that's helpful or not, is it? But that's the framework that we look at that issue through.
Yeah, absolutely. No, very helpful. You mentioned nuclear there. Would that fall as a commodity that you would consider within your fund? It's got the clean credentials, but obviously it's got a large stigmatism with it, certainly on the public level.
Yeah, nuclear is a massively, probably one of the most controversial topics that we can talk about as investors. So when we come to talk about nuclear, I try and stick to the facts of nuclear, which is the facts are that it's wildly too expensive in Europe and North America, and it looks really, really good value in other parts of the world. We look at the fact that it's really low carbon, it's really reliable. We struggle to dispute these kind of data points are just sort of factually correct.
Yeah.
And objectively, when looked through an objective lens at the data, it's also safe.
Yeah.
And you put all that together to say this is a source of power which should play a really important role in the world. I think the recent change in the uranium price is telling you that maybe the world is changing its mind about the role that it has to play. You have to look at the uranium price reasonably cautiously if you're a uranium junior, but that's probably not the question that I'm being asked right now. And then you have to look at the fact that frankly, nuclear is probably one of the most widely hated sources of electricity generation. And the surveys we look at suggest that global average, something like 3 in 5 people hate nuclear. So it's almost no issue guaranteed to get me into trouble more quickly than talking about nuclear in a sort of on record public domain conversation because of that irreconcilable difference between what people think of it and what the data tells you that they should think of it.
Yeah, it's very challenging indeed, because the low carbon credentials are, as you say, so fantastic in the decarbonisation debate. James, is that something that you would look at or make consideration for within your team at WoodMac?
We don't actually cover the uranium market. I follow it with interest. We look at nuclear. I think, this year when we look at the recent power outages, they probably serve as a bit of a harbinger of the challenge to come in maintaining reliability while accelerating decarbonisation. We've seen it in Japan, Australia, Texas. There is this much higher share of renewables, and now we've got seemingly extreme temperature fluctuations leading to demand spikes. So I think nuclear power is definitely key to meeting the goals of the Paris Agreement. But what we're seeing is that some countries are moving ahead with it, like China, while in Japan and Germany, they're sort of phasing out plans. But I do think the market at the moment for uranium in particular is being driven by short-term speculation. There's a couple of new funds that are coming into the market, rather than the structural undersupply, which will probably develop at some point in the future if China's plans are followed through on.
Yeah, certainly. There's certainly not a lot of new supply coming online. Raising the point around China, we've just had a question come in live, and I think this perhaps is a good way to end on. We're coming back to this sort of scope 3 issue, looking across the value chain. At some point, you're going to be dealing with China in some industries. Who's auditing China, or how do you get around the challenge of the nature of their closed book economy when we're in the extractives and metals industry that we're in? Anyone wants to sort of tackle that? The trickiest question of the day. Yeah.
Save the best till last. I think it is integrated, right? So everything from mine through ownership, foreign ownership, through to the smelters. Where it will come into contact with Western economies is in the end products most likely. And there's new regulations that are coming into place in Europe. The battery passport regulation that's being brought in will probably see that being where most of the action happens in terms of regulation to encourage localization of supply chains.
Yep. Unless anyone's got anything further to add on China, perhaps? No. That's great. Okay, well, look, that's taken us to an hour. I don't want to keep everyone else from their days, respectively, mornings and evenings that we're picking this up. Thank you very much to everyone tuning in. I'll just say a huge thanks to Nick, Ian, Mark, and James for giving us your time and expertise. It's really been fascinating. So thanks for joining Assay Live.
Thanks, Adam.
No, thank you. It was great.
Thanks, everyone. Have a good rest of the day.